What's up everybody? Gen X Dividend Investor here. In this video I'm going to talk about SCHD, my favorite dividend ETF out there. I'll also share a small tweak I made to my dividend portfolio recently. So unless you're the Sultan of Brunei, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Okay, SCHD is the Schwab US Dividend Equity ETF, which was started in 2011 and holds around 100 stocks at an expense ratio of 0.06%. That's a nice and low expense ratio, and it just means that if you invested $10,000 into SCHD, then Schwab takes $6 of your returns each year as a fee. SCHD attempts to track the Dow Jones US Dividend 100 Index. That index has US stocks, excluding REITs, that meet certain criteria, including number 1, 10 consecutive years of dividend payments, number 2, a float-adjusted market cap of at least $500 million, and number 3, a minimum 3-month average daily traded value of $2 million. So SCHD could have stocks that only have a few years of dividend growth or even no dividend growth, as long as they've been paying dividends over the last 10 years. And float shares are the shares that people like you and I can buy, as opposed to insider shares. And remember that market cap is just the number of outstanding shares times current share price. Okay, so what SCHD does is take all the stocks that fit into their criteria and sorts them based on yield, and then throws away the bottom half of the sorted list. Then they score the remaining stocks based on 4 criteria: free cash flow to total debt, return on equity, dividend yield, and 5-year dividend CAGR. Finally, they take the top 100 stocks based on that scoring, and that's what ends up as part of SCHD. They weight stocks based on a modified market cap and have rules in place to ensure that no single stock can represent more than 4% of the fund, and that no single sector of it can be more than 25% of all of it. I was looking over the methodology for the Dow Jones US Dividend 100 Index and saw a line that said, "The constituent stocks will remain in the index as long as they're among the top 200 rankings by the composite score." So while a stock has to score in the top 100 to initially get into SCHD, once they make it to the list, then even if they fall down to the 200th spot, they would still remain on the list. Okay, let's take a look at what sectors SCHD has in it as of 3/31/22. So we see that financials make up the largest percentage at 21.1%, followed by tech at 20.6%, and then consumer staples at 14.2%. On the bottom of the list, we see that energy stocks are at 4.6% of SCHD, materials are at 4.1%, and utilities are at 0.3%. Those all seem reasonable weightings to me, though obviously this year a low energy holding hurts it a bit since energy has been doing so well. Now let's look at SCHD's top holdings. You can see that these are all blue chip names you'd recognize, including a few I'm long in, such as Pepsi, which is 4.11% of SCHD, Pfizer also at 4.11%, and Coca-Cola at 4.07%. Now I'd personally rather see Apple and Microsoft instead of IBM, but if they did that, they'd lose some yield in favor of greater probable stock appreciation, which some dividend investors don't care as much about. Moving on, this shows us that SCHD has a relatively low turnover of 13.5%. Turnover is a measure of how frequently assets are bought and sold by the fund, which is something SCHD does to update which stocks it holds as well as what the weighting is. A higher portfolio turnover may indicate higher transaction costs and may result in higher taxes when fund shares are held in a taxable account. These costs are not reflected in the annual fund operating expenses. We also see that it has around 35 billion assets under management, which is a solid amount. I avoid funds with a low AUM. Beyond that, we see that SCHD has decent volume, which means it should be easy to buy and sell. Let's see how SCHD has done over the years. We see that since inception in 2011, it has gone up over 180%. That's decent, but it slightly trails the S&P 500, which had over 200% stock appreciation in the same time frame. But now let's look at total returns, which also includes reinvested dividends. I backtested SCHD against the S&P 500, as well as against VYM, which is the Vanguard High Dividend Yield ETF, as well as against VIG, which is the Vanguard Dividend Appreciation Index Fund. And now we see that when we include reinvested dividends, then SCHD outperforms all of those, including the S&P 500. Specifically, SCHD had an annualized 14.45% return since inception, which is awesome. I'm happy to get around a 10% annualized return. Of course, you can find periods of time where SCHD underperforms relative to others, but I think it's good and rare to find a fund that beats the S&P 500 over a decade in terms of total returns. And as always, historical performance is no guarantee of future performance. The backtest I ran on Portfolio Visualizer said that this is how income played out over time, assuming you reinvested your dividends. In 2012, a $10,000 investment into SCHD would get you $313 in annual dividend income that year, which means it had a 3.13% yield. we see that Vanguard's high dividend yield ETF had a slightly higher starting yield at 3.56%, and the Vanguard dividend appreciation ETF had the lowest starting yield at 2.6%. And then if we look over time, we see that SCHD's dividend has grown the fastest, and in 2021 it would have yielded $1,138 of dividends versus $919 for VYM and $591 for VIG. The S&P 500 is currently the lowest yield of the bunch, running well under 2%. If we look at Seeking Alpha, we see that SCHD currently has a 3.86% yield, paid out 70 cents per share in the most recent quarter, has an incredible 5-year dividend growth rate of 13.32%, and has increased their dividend for 10 consecutive years, i.e. every year that it's existed. Looking at SCHD's history of dividend yields, you can see that it's usually around 2.8% or so, though it did spike higher during the pandemic crash. On Schwab, they list SCHD's SEC yield as 3.46% and its distribution yield at 2.88%. Distribution yield is basically its yield over the last 12 months, whereas SEC yield is basically its yield over the last month. Also, unlike most single stocks, dividend ETFs tend to have more volatility in dividend payouts. Like here are the last 10 years of SCHD payouts, which have trended up, but also have been bumpy. So while the last quarter paid out 70 cents per share, the quarter before that only paid out 52 cents per share. But that's kind of what you'd expect, as SCHD is basically a portfolio, and if you had a portfolio of dividend stocks, then quarter to quarter things get bumpy. What's been even more bumpy lately though is the stock market. And it's never been a better time than now to own solid dividend companies, which keep paying out some of their profits to their shareholders. Of course, if we do have a big recession or even depression, like some experts predict we will, then stocks will probably crash. And it could take a long time to get back to previous peaks. Thus, if you are risk averse and haven't started investing yet, then you might feel more comfortable just slowly dollar cost averaging into equities over a long period of time, as trying to wait to invest once things really crash and then buy in at a good price is very challenging. Regardless, while some non-dividend investors freak out in these volatile markets, us dividend investors can relax as we keep getting true passive income while doing nothing. Speaking of doing nothing, I just realized that many brokerages let you set up auto withdrawals of your cash dividends directly into your checking account on a daily basis. I've been transferring my dividend cash out manually to pay my expenses, but I never noticed you could automate that. I'm planning on going on a vacation in a few weeks, so it'll be fun seeing my dividend cash flowing directly into my bank accounts even when I'm exploring Europe. And dividends are really amazing. This auto transfer feature will be really helpful for my wife if I'm ever not around to oversee things. Of course, it's usually better to reinvest those dividends if you don't need the cash to live. Another reason now is a great time to own dividend stocks is due to rising interest rates. As interest rates go up, investors usually turn from growth stocks to value stocks, which is what classic blue chip dividend stocks are. Now, if you're new to my channel, then you may not know why I own single stocks rather than ETFs. It's mostly because I enjoy researching and owning single stocks rather than baskets of stocks, and that enjoyment has kept me motivated over the last almost 3 decades to keep investing. You can hear some of my other reasons if you watch my video called Should You Invest in Dividend ETFs or Dividend Stocks? Anyways, in my experience, dollar cost averaging into ETFs like VTI or VU has historically been smarter for most people, even though I don't. Well, I should say even though I don't currently. There was a time that I moved everything into VU, which I talked about in an emotional video called The Time I Sold All My Stocks. But now I think SCHD would have been a better choice for my family rather than VU. I mean, I needed something that was hands-off and generated good income and something that would keep growing over time. VU or VTI have always been my favorite ETFs for most things, but one downside with them is their low 1.5% dividend yield, which probably wouldn't yield enough income for my wife and kids if I wasn't around. But given the craziness of what I was going through at the time, I just went with VU. I wasn't a fan of income funds, which were big on income but not so great for appreciation. Now that I resolved all the tax issues I had, my plan now would be just to stick with single stocks, even though I know long term they would be more challenging to deal with than a single ETF. But if I did decide to go into an ETF, then SCHD would probably be it. In fact, I think if you're a new investor looking to get into dividend investing, then SCHD would probably be a solid choice to consider. I also think that VYM and VIG are solid dividend ETFs, and if you went with them, then I'm betting you'll be happy over the long run. They both hold a broader cross-section of the market, so if you really value that, then they may make more sense for you. DGRO is another good dividend ETF that many people like, and it has a greater concentration in tech, so it's another solid one to consider, as over the long run tech has been, and probably will remain, an area of good returns. But energy, utilities, and staples have been the best performing sectors in the last year, whereas tech has been one of the worst performing. So do you think we're headed into a decade-long depression? If so, do you adjust your investing approach? I personally focus more on a business's fundamentals than I do on the macroeconomic environment, but there are many ways to achieve your goals with investing. A core point for you to realize is that what you invest in depends on your goals, needs, and risk tolerances, not mine. In this video, I showed you some of the things I look at when investing in ETFs, such as expense ratio, methodology for what they hold, how many stocks they hold, what sector concentration they have, how long it's been around, who manages them, how many assets are under management, their current yield and historical yield trends, their dividend growth history, their performance over various time frames, etc. Bottom line, SCHD isn't perfect, but nothing is, and it has its risks, like all investments, but I feel it's a solid dividend-yielding investment that I'd be happy to invest in. Of course, I personally love owning single companies too much to go with SCHD, plus I have more flexibility to optimize my buys and sells with single stocks, but honestly for most people I think ETFs are going to be safer and easier to invest in. Another option to consider is having some percentage of your investable assets in an international dividend ETF like SCHY, which is Schwab's International Dividend Equity ETF, simply as a way for broader diversification. Maybe 70-30 SCHD, SCHY or something. I mean, good US companies often have revenue coming in internationally, but a more world-centric portfolio might help hedge the case if US equities don't perform as well as they've done historically. I'm personally fine staying focused on US companies, but others might want to be more heavily weighted internationally given where they think the future will be. Anyways, hopefully now you can understand why I like SCHD. I mean, it's gotten great overall returns combined with excellently growing income over a decent time frame. It's got a good diverse bunch of stocks, along with a decent process to evolve what's in the fund. And it's nice and cheap and liquid. Plus, Schwab has a great name in the investing community, kind of like a Fidelity or a Vanguard, so that gives me further confidence in their product. SCHD's cons are pretty minor. One obvious con is that you aren't getting non-dividend stocks like Google. Another con would be that there could be times where it'll underperform, kind of like this year with energy, since energy is a low percentage of SCHD right now, but there will also be times where it overperforms, so that's not really a con. A con is that it's missing some dividend stocks I'd like to see, and it has some stocks I'd pass on. A couple other cons to SCHD might be that it's too top-heavy, i.e. both from having large concentrations in few stocks, along with being large-cap stocks only. And a con to some might be that its yield is too low for them. Anyways, there are lots of decent dividend-centric ETFs out there, so leave me a comment telling me what your favorite one is if you had to just pick one. I ran a poll on my Dividend Discord asking people what ETFs they like, and SCHD got the most votes by far, followed by VU and VTI. And there's a bunch of others people like to talk about, including DGRO and SPYD and CDC, and of course there's people who love JEPI and QYLD and those stocks. Whatever you do, consider reinvesting your dividends to really accelerate your compounding. Okay, now I'll share a small change I made to my dividend portfolio. So if you're one of my Patreon aristocrats or kings, then you know I did this already, since I share my dividend trades in my upper tier Patreon Discord channels. Sometimes I might also communicate trades in my YouTube comments, or on Twitter or Instagram or wherever. Anyways, I've not been a fan of financials since 2008. I mean, I didn't like the fact that some companies needed to be bailed out by the US government and were seen as too big to fail. Then again, maybe it's kind of nice to know that the government will save their bacon if they need to. The reality is that I should get over my financials aversion, because there is a lot of money to be made there and financials are like 10 to 15% of the market. I consider Goldman Sachs and JP Morgan Chase to be two of the strongest US companies in the financial sector, and I originally went with Goldman for the reasons I called out in my long analysis video I did almost 3 years ago. At that time, GS was the 20th position in my dividend portfolio, so quite small at under 2% overall. And as I mentioned in my GS video, I had some concerns that their dividend wouldn't be treated seriously. That concern struck with me, and when I had some extra capital to invest, I decided I'd move into JPM. And the fact that I was doing that in a retirement account allowed me not to worry about tax implications. Anyways, Goldman recently announced another significant dividend hike, which gave me more confidence that they are indeed keen on promoting their dividend. JPM decided not to raise this quarter, but I'm guessing they'll raise it before the end of 2023 if things go good for them, and doing that should allow their dividend streak to continue. Of course, given the US banking industry, I realized that any of them could be compelled to pull their dividend at any moment. Regardless, I decided to go all in with Goldman with my banking financial allocation. Another option I considered was moving into Canadian banks. They have a much nicer history of supporting their dividend and did better in the 2008 financial crisis. One thing to be aware of is that if you hold a Canadian company in a taxable account, then my understanding is that they will withhold 15% of your dividends as a Canadian tax, which you can recover if you file a specific form come tax time. However, if you hold a Canadian company in a retirement account, then they don't withhold that 15%. Another thing to be aware of about investing in international companies is that currency fluctuations impact dividend payouts. For example, this is data I put together from BTI's website, matching together their quarterly payouts in British currency and in American currency. So we see that in May of 2021, they paid out 53.9 pence per share, aka 75 cents per share in America. For reference, 100 pence is equal to 1 British pound sterling, which is the equivalent of $1.21 in US currency as of today. Then you can see that they again paid out 53.9 pence in their August, November, and February quarterly payments, and then they did a small hike, taking their May of 22 dividend payout to 54.45 pence per share per quarter. But look at the American payout equivalents. They paid out 75 cents in May of 2021, then 73 cents in August, then 72 cents in November, and then 73 cents in February. And then even though they did a dividend hike for their May payout, we see that the American payout fell the most, down to 68 cents per share per quarter. That's about a 10% drop in dividend payout from May of 2021 to May of 2022, even though they actually did a small hike in their local currency. Now sure, there will also be times where currency can be in your favor and you could go up 10% or whatever, but I still don't like the volatility. Anyways, I like JPM and GS and Canadian banks, but for now my portfolio is holding GS and I may DCA a tad more into it if prices remain cheap and I overcome my own resistance to investing too much in financials. And a lot of them look pretty compelling these days, though I recognize that things could keep trending south. And beyond that, make sure to hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Also, please share one of my videos with someone younger than you. I mean, hey, pay it forward. Okay, now I'd like to shout out my newest Patreon aristocrats who have signed up since my last video. So thank you Matthew Burgess for signing up. Aristocrats gain access to my dividend portfolio tracker spreadsheet, which I use in lots of my videos, and they get special access to various private channels on my Discord, including one which lets you watch my videos before I release them publicly on YouTube, as well as lets you vote on which thumbnails I should use, and you get more direct access to me. There are limited Patreon Aristocrat spots remaining because of the hands-on support I provide, so sign up now if you're interested. Finally, don't forget to join my free Dividend Discord chat server, which has thousands of investors on it from around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.